It was another ugly day on Wall Street as we saw the S&P 500 down 2.78%. The Nasdaq was down 4% as a lot of those work from home and other mega cap tech stocks really got hit once again here today. That was actually the third straight day those types of stocks have sold off aggressively. So we're kind of going into this holiday shortened week on the wrong foot here, and it actually did have a negative effect on our postures for our various indices. We'll talk about that. We'll then get into our trade application example where I placed a trade that was a bearish trade on a real estate company that is sometimes forgotten about as a real estate company. You could think of it as an alternative real estate company. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 8th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then check out our description area, sign up for our email distribution list, so that way you're notified whenever we post these videos. We're also heavy users of Twitter. If you're not doing so already, make sure you're following me. My handle is @BrandonVanZ, and I appreciate those of you that click like and retweet on these Market Outlook related tweets. And lastly, we do have a presence on Facebook as well. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts. And as you can see, I've got chart 6D pulled up here in front of us for those of you that are premium members following along at home. Now remember, I usually start off with this particular chart if we have more than a 1% up or down day, and today was definitely one of those days. We were down 2.78% on the S&P 500, and you can see kind of what that looks like in the middle of our screen here. Remember, I was with you on Thursday on this candle talking about how once we breach that pink horizontal line there, that's a 3% move. Speaking of pink, I saw she was celebrating her birthday today, according to Twitter. So a lot of pink on our charts today, I might add as well. Anyway, the red bar right here, you can see today crossed this orange line. It didn't quite get to the pink line, but it did breach the orange line. So in other words, we were down somewhere between 2 and 3%. And the purpose of this chart is to give you a sense of whether that is a rare occurrence, whether it's something that happens all the time. We have to remember that there are regularly brand new students that are watching these videos. And while some of you that have been around a while kind of get a general sense of whether something is out of the ordinary or not, there are people that are just starting investing today. And for those of you that that might represent, do know that a 2.7% down move like we saw here today is somewhat abnormal. Now, that is in a typical year. This year, it's not abnormal. And you'll have to remember that pretty much every year we have at least a 5 to 10% pullback in general, and a lot of times that does include a random 3% down day here or there. But 2020 has been one for the ages when it comes to aggressive price action. And we can use this bar right here to help us identify just how not rare this has been, at least if you're looking since the beginning of 2020, because during the worst of the coronavirus fear is this area that I'm kind of circling in the middle of my screen here. And you can see that we regularly had days that were well in excess of sell-offs of 3% or more. And, equally, we had 3% up moves as well. So we kind of went into this period here going into July and into August where we calmed down quite a bit. In fact, a lot of these candles right here started to look a lot more like what we experienced at the end of 2019 before we had any idea what the coronavirus was going to do. So it was almost as if this move that we saw marching higher kind of lulled us to sleep, and all of a sudden we've been jolted out of bed here in the last 3 sessions. Once again, you can see what that looks like on the chart up here after hitting an all-time high just on September 2nd. We've now had 3 days in a row to the downside, and once again it was the Apples of the world that really did that. Now, before we beat up on Apple and Microsoft too much, we have to remember they were the ones that were the whole reason we went to all-time highs in the first place. So what goes up does tend to come down, and they are due for a little bit of a rest, which they're taking right now as we head into this more tumultuous time of year from a seasonality perspective. Remember, we've been discussing that here recently, that September and October are somewhat notorious for having market crashes, and there's just a little bit more nerves in the air, and particularly as we are in an election year, there's a little bit more uncertainty out there, and so we have to be able to kind of brace whatever storm is heading our way. Speaking of storms, we're getting some unbelievable winds here today in Utah, and we woke up to 40-degree temperatures, and we were just at 99 degrees a couple of days ago. So I know a lot of you are going through some crazy weather swings where you're at as well, and we're seeing the same type of erratic behavior here in the stock market. One thing that did catch my eye today that was maybe a little bit surprising to me was that the VIX ended at 31 here today. You can kind of see that purple bubble down into the right, and you can kind of see the trajectory of the VIX over time. Of course, back here in the middle of March, we were at like 80 on the VIX, so we're all the way back down to 31. Remember, this is sometimes referred to as the fear gauge or the fear index. And so when the VIX goes up, there's more fear in the system. When the VIX goes down, there's less fear in the system. That's kind of broad strokes, but at least is a way for you to kind of get a general grasp of it at the beginning. But what was a little bit surprising to me was that it didn't really move up all that much today. It was up like 2%. That's it. Usually on a day when we are getting blasted on the stock market, where the whole index is down nearly 3%, the VIX is usually going to make a move of high single digits, low double digits in terms of percentage moves. So maybe it kind of built that into it or baked it into the cake late last week already, or maybe there's an opportunity here where the VIX will top out, in which case selling premium could very well end up being a very interesting strategy going forward. So we'll talk about that, because we are going to be doing a selling premium trade at the end of this video, or at least the driver of the trade is on the sold side of the equation. I also wanted to bring up the Market Watch tab here. Whenever we have a big day, it's always kind of interesting, try to get a sense of where the big movements were from an individual stock price perspective. And as I mentioned before, it was Apple that led us up, and it's now Apple that's bringing us back down. And I shouldn't just say Apple. Of course, you could throw Microsoft and Amazon and Facebook and Google in there as well. But you can see that the deeper the shade of red, the more aggressive the sell-off was. So in the case of Apple, we were down almost 7% today. That's a pretty ugly day for a $2 trillion company, although I heard they may have lost that $2 trillion status. Yeah, they did. You can see the market cap right there. They're now down to a lowly $1.9 trillion company. So I don't think we need to send them any sympathy notes or anything like that, but they are no longer a $2 trillion company. Microsoft is a $1.5 trillion company. They were down 5% today. Amazon is a $1.5 trillion company as well, so they're kind of going back and forth with Microsoft as to who's second to Apple. Anyway, they were down 4% today, and then a couple of the other big players out there, Facebook was down 4% and Google was down about 4%. So you can see here there weren't a lot of green patches on this board. One of them that I guess is somewhat noteworthy is there's a really dark shaded green down below here, and that is General Motors. General Motors was up 8% today on a partnership with, I believe it was Nikola Motors, electric truck manufacturer. So that seemed to excite the marketplace. But if anything, just seeing how small that little patch for GM is these days is kind of noteworthy. For those of you that have been trading in the markets for decades, you'll know that GM used to be considered one of the most important companies on the planet. It used to say as GM goes, the United States goes. And these days, GM, from a market cap perspective, is almost an afterthought at only $46 billion. But they finally had a successful day today with a nice 8% up move. We also saw McDonald's up here today a little bit. We saw Nike up here today a little bit. Disney was up a little bit, and AT&T was up a little bit. So, you know, you had a few bigger companies that were kind of bucking the trend, but for the most part, this is another sea of pink or sea of red here today. If we wanted to take a look at it from a slightly different perspective, I wanted to show you that in the S&P 500 today, there were only 52 stocks that finished in the green. That means 450 effectively were in the red here today. So this was definitely a bad breadth day where basically there was only one winner for every 9 or 10 losers out there in the S&P 500. So pretty ugly day across the board. And that should not surprise you then when I come on over here and show you our traditional setup now for the market forecast. This will be chart 4B to give us a sense of what's happening with the 4 major U.S. equity indices. And as I mentioned in the intro, today was a biggie, not necessarily because of the aggressive move lower. We've certainly seen moves worse than what we saw today. It was a biggie from the perspective of the posture change. You can see that in the case of 3 out of our 4 charts here, we flipped from bullish posture to bearish posture. And those 3 charts are the S&P 500. Notice how the background color went from green to pink. Same thing happened here on the Dow Jones Industrial Average, green to pink. And the same thing down below here on the NASDAQ Composite, green to pink. Russell 2000 was already there, so that wasn't necessarily new information. It has been bearish for the last couple of sessions prior to today. So we are at a rare situation now where all 4 of our charts actually have weekly bearish intermediate postures according to the market forecast technical indicator. And remember that market forecast technical indicator can be found on the Thinkorswim platform, and it's these different colored lines that are oscillating down below the charts here. And you can see in all of those cases, those green lines that were once firmly implanted in the upper reversal zone above 80 have now all fallen out of the upper reversal zone and are now trending lower, in which case we have now switched the posture. Now remember, it's not a strongly bearish posture yet. That does not occur until that green line crosses the 50th percentile. And the one that would be closest to doing that at this moment in time is the Russell 2000. You can see its reading is at 64 right now and falling. So you can kind of see it's falling there, but it's not quite to 50. But if we do continue to see selling pressure in the market, it will likely be the Russell 2000 that goes to a strongly bearish posture first. The others, we have to remind ourselves that while the last 3 days have been somewhat uncomfortable, particularly for folks that are in the high tech and work from home stocks. Those are the ones that have been hit the worst here in the last 3 days. So naturally, that's going to make you feel a little uncomfortable. But we do have to remind ourselves of history, and history does suggest that there's been plenty of examples where these types of sell-offs have actually led to a better buying opportunity than a selling opportunity. You can see in the case of the NASDAQ, for example, that this is actually the first time that we've closed below that moving average. This is a 30-day moving average in 3 months. Notice that the moving average tip is now yellow, same way that it is up here with the S&P 500, the Dow Jones, and the Russell 2000. What that signifies is that price is currently below a rising moving average. So the moving averages are always lagging in nature. They're, in this case, looking back the last 30 days and averaging out those prices. So right now, the current price action is moving too quickly for a lagging indicator. And what that is telling us is that they're giving us kind of 2 different philosophies. The current sensitive price action is pushing its way down in the last 3 days, which is kind of bearish in nature, whereas the lagging indicator, the moving average, still would be considered somewhat bullish. It's still moving to the upside. So there's kind of conflicting thoughts there. And we need to kind of wait and see how that is going to be resolved. Right now, what I would say is, I'm still going to bet that the bulls are going to be able to resolve this to the upside. Now, whether they get it back to all-time highs here within the next few weeks or anything along those lines, I don't know. We have to look at that on a case-by-case basis. But generally speaking, we have a lot of bullish trends that are still in place here. We also have plenty of money on the sidelines from people who just couldn't believe what they were witnessing all summer long. thinking to themselves, this economy is in tatters. How does the stock market keep on going up? And they just refuse to get involved in the stock market. So I think there can be a little bit more frustration for those folks if they start seeing some of these stocks work their way higher again. And in the case of the NASDAQ, yes, it's true. We have a weekly bearish posture at this exact moment in time. That's what that kind of light pink background color signifies. But remember, this is not our first rodeo. We had light pink background here. We had light pink background here, light pink background here, and right here. So we've had 4 other examples of weekly bearish postures in the last 3 months on the NASDAQ, and it hasn't led to anything other than a buying opportunity to buy cheaper prices as that particular index was destined for all-time highs. It is true, this one is different. This one is a little bit different because it is now below that falling moving average. But the point I'm trying to make is I don't think it's a guarantee that all of a sudden the bears are just going to take over in this market. I think there's still a lot of money on the sidelines, and I wouldn't be surprised in the slightest if we start catching a little bit of a bounce in around this area. And it's possible we need to go sideways for a while and not hit new highs. But I don't think we're just going to go down every single day here and find ourselves back at the lows from March, in the near term. So if that changes, of course, that's the whole point of having these videos every day, is to notify you of how things are looking. But right now, this is effectively just a normal little sell-off that we're experiencing here, and it's part of your entrance fee to be participating in the stock market. In order to have the opportunity to earn reward, you need to be able to take on risk like we've been witnessing in the last few sessions here. So that's the big news, is we are now weekly bearish intermediate posture according to the market forecast on all 4 of the equity indices here in the United States. Let's take a quick little step over to the internet, and wanted to quickly say thank you to those of you that clicked like for me the last time around on Twitter that I did the video, which would have been on Thursday, since we were up and over 100, which is typically my goal. We'll make sure that this video here tonight is a full-length 30-minute video. Remember, if you prefer the shortened or abbreviated 15-minute version, then don't click like on Twitter. If the number of likes is less than 100, then the next time I do the video, I'll only do it for the 15 minutes. But for those of you that prefer the somewhat longer video, then just go ahead and click like, and your vote, so to speak, will be tallied right along with everybody else's there. So thank you to those of you that did that for me last time around. Also wanted to mention that we had an excellent dividend growth investing class here today. We've concentrated on the financial sector. So I'm still waiting for WebEx to send me the file back on that. Once it is sent back to me, I'll get that updated and posted to our Trading Rooms calendar up here. And David taught his directional option strategies class today, and tomorrow I've got my factor-based swing trading class at 11 a.m. Eastern Time, and then David's got his options inventory class at 2 p.m. Eastern Time. So lots of great content coming your way here at Market Scholars for those of you that are Premium and Plus members. And if you're not a Premium or Plus member, come on over here and click on our pricing tab and check out what we have to offer there. Also, over the weekend, I did put a post out there regarding dividend growth investing with some of the increases we've seen here recently. So this will cover all of the stocks that raised their dividends in the month of August. And remember, this has not been necessarily an easy environment to be raising dividends in because of our economy. So some of these stocks may be worth a second look if their board of directors feels like their business is strong enough to be able to convince themselves that they can raise the dividends in this environment. So feel free to check that out as well. Remember, if you're looking for that on our website and you come on over here to the blog area, if you hover over blog, you can then click on dividend growth investing. You can see that particular post along with prior months as well. And remember, that's a free feature. So for those of you that are out there just kind of checking out what we have to offer, that's something that you can access no matter what your subscription level is. Also, real quick here, over on Twitter, I did post the upper half of the sector selector. I didn't do the lower half this week since we didn't have class on Monday as a result of Labor Day, but I did at least want to quickly show you here on the sector selector that we did have a little bit of movement up at the top. We saw communications fall from number 1 down to number 4, and we saw technology fall from number 4 down to number 5. And as I kind of mentioned in my tweet, given the sharp sell-off in the work from home and software names this week, it's not too surprising to see communications and technology decline in the sector selector rankings. Materials is the new king of the hill, and you can see that by clearing out communications, materials was able to make a very nice launch higher. But other than that, we didn't really see any ranking changes week over week. All right, back on track with some more charts now. Let's go ahead and take a peek at the 3 green arrows now, because I'm assuming none of them have 3 green arrows. But let's just verify. Yeah, in fact, we have the opposite of 3 green arrows. We have 3 red arrows in all 4 of our charts cases here. This is chart 4D for those of you that are following along at home. And the background colors on these charts will change from pink to green depending upon whether we have so-called 3 green arrows or so-called 3 red arrows, with the 3 different technical indicators that we're referring to with those arrows being the 30-day moving average, the MACD histogram, and the stochastic. And in this case, you can see that with the fall below the moving averages, we received red arrows with 3 out of our 4 charts there. And that basically allowed them to join the red arrows that had already occurred late last week with the MACD histogram and the stochastic. So just another sign of hesitation more than anything. Again, it doesn't have to mean that this bullish move that we've seen since March is overdone with, finito. Nothing like that. It just basically means, hey, the markets have hit the brakes here a little bit, and we need some further evidence to suggest what to do next. And it's possible we just have some rotation too. Remember that markets have to change money from one sector to another or one style to another. And it doesn't necessarily have to mean that when that rotation takes place that the overall market has to fall. So who knows? Maybe this is just a moment that after several years of seeing technology do as well as it has, maybe technology needs to have some time in the penalty box. Maybe it needs to pass the baton to something like materials or industrials that haven't necessarily been in the sunshine quite as much in recent years. So keep that in the back of your mind as well. I know sometimes you turn on business television and everybody's panicking and pulling their hair out about how the most popular tech stocks are just capitulating left and right, and we have to remember that the market is not just tech stocks. There are plenty of opportunities out there, but right now it is true there's a sign of caution in the air with 3 red arrows on all 4 of these charts right now. Let's go ahead and do some 12 grid analysis, and I'm going to start with chart 5A. This will be our asset class 12 grid. Now remember, the background colors of these 12 grid charts will signify whether we have a bullish posture, in which case the background color will be green, or we have a bearish posture, in which case the background color will be pink. Now, there are 2 different shades. There's a lighter green and a darker green, and there's a lighter pink and a darker pink. And right now, we have kind of 3 out of those 4 possibilities in this set of 12 grids in front of us here. Let's start with the charts that are the deepest shade of pink at the bottom, and that is gold and oil. You can see that the US dollar over here to the left actually had a pretty strong day. US dollar was up over 0.5%. Now remember, that's an entire currency, so that's a pretty aggressive move there. In fact, some of you that follow cryptocurrencies might have noticed that Bitcoin has been really falling here, along with a lot of the tech stocks and the work from home stocks. They're all kind of caught up in the same momentum type of basket or mindset out there. And so Bitcoin has fallen like 20% here in the last couple of weeks and is now down back around 10,000 or so. Money is starting to rotate into maybe what it perceives to be safer areas, and you do have the ability to debate what safe means to you, but generally to the market, you can see that the US dollar gained from a currency perspective on its other currencies around the globe, such as the euro and the yen and the yuan and the rubles, etc. You can also see that long-term U.S. Treasuries, so long-term government bonds, also attracted investor money today, as they were up 0.61% today. So oftentimes, gold can sometimes catch a little bit of a bid in that type of chaotic market. I think what makes it a little bit different this time is that gold had almost turned into a momentum security earlier this year. So it went right along with a lot of those work from home stocks, a lot of those tech stocks. And so I think that at this exact moment in time, they were not necessarily able to benefit from the, quote unquote, safe haven trade here today, because they kind of already earned a lot of their goodwill back here during this big move higher. It's not as though gold fell completely apart today. It was only down 0.19%. But the concerning element of the chart now is that the moving average is now red. Remember, we were having this conversation last week as well, saying, okay, watch gold. This is an important point for it to hold, because you've got a lot of that horizontal support level right in this area. And that is still true. That hasn't really been broken yet. So I think there's still a little glimmer of hope for gold. But each consecutive day, as we have more and more evidence presented to us, suggests that, hey, this thing may have seen its good run already. With that moving average now turning red, the fear becomes, if we get a bounce up to that moving average, it now uses it as resistance and starts bouncing it back down. So, as always, we're going to keep our eye on it, and we'll let you know as we see things here in these videos, what is catching our eye. But right now, I've grown even more concerned about gold after seeing the action that I have, and that's unfortunate. I'm a guy that I kind of enjoy watching gold go higher. I think it takes it back to about 15 years ago or so. I used to trade a lot of gold stocks, so maybe I have a special place in my heart for them. But I kind of enjoy watching the gold miners and gold itself do well. And so I for one, was hoping that this thing could really start taking off to the upside. But, if it's not meant to be, it's not meant to be. There's no sense arguing with the chart. And right now, the chart is suggesting that we have a little bit more bearishness there than we were expecting. Now, oil, that's a different story. Take a look at how oil just completely fell apart today, down over 6% here, at least if you're looking at USO as your proxy. And that was a statement type of a day. Now remember, USO was not open for trading yesterday because of the Labor Day holiday, yet crude oil futures were already trading. So sometimes you see this, monumental move out of the commodity tracking ETFs and ETNs when you have a holiday weekend, because you kind of have to play catch up to what the futures contracts were already doing the day before. So we have to remember there's part of that with this story as well. But that is a pretty aggressive meltdown in the last week, whether we were trading yesterday or not. And you can clearly see that it is now broken a number of key support areas. And the same thing as what I just mentioned with gold, we now have a red tip on the moving average. So that means price is below a falling moving average at this time. Now remember, a lot of this is directly a result of what's going on with the dollar. When the dollar does well on a relative basis, generally speaking, commodities will struggle on a relative basis. Not always, because there's plenty of other factors that are involved, but that is definitely one of the key factors that you want to keep your eye on as an educated trader and investor. And so if you anticipate that the dollar will continue to strengthen, you might also be expecting commodities to weaken in that type of an environment. Other charts worth mentioning are on the top rung. You can see some of that similar behavior here now out of EFA and EEM. And what I mean by similar behavior is the red moving average tip. In other words, not only is price below the moving average, but the moving average itself is lower. So similar to gold and oil, we're seeing some more pressure now on those foreign areas. And remember, foreign investments tend to underperform on a relative basis in a strengthening dollar environment as well. So we're kind of seeing that a little bit, not necessarily on a one-day basis, but over the last little time here, you can see that they've maybe struggled a little bit. At least EFA, we can make that claim. EFA is actually down 1.42% over the last 3 months. Remember, the S&P 500, after having a really ugly 3-day pullback here, is still up over the last 3 months, as is EEM. So it's really where we're seeing weakness is kind of in the developed foreign world. So that would be Europe and Australia, Japan, etc. Real quick here on the sectors now. This will be chart 5C, but we already kind of talked about the sectors a little bit with the sector selector, but this is a slightly different view of things here. One thing I wanted to point out is that all sectors finished lower today, so all 11 were in the red. The worst offenders were technology, down 4.52%, and then also energy, down 3.64%. You can see that there's only one green chart left on the board, and that's industrials, which was one of those that was still in the top 3 in the sector selector as well. But you can see industrials continues to be trading above a rising moving average, and it's just barely hanging on to having its intermediate line in the upper reversal zone, just barely above 80 at this point. But remember, that could go away as soon as tomorrow. There are some other charts out there that don't look too bad. Discretionary, I think, is still interesting from a bullish perspective. Yes, you have that pink background color, but it's just sitting right there on that rising moving average. It hasn't really broken much support there. I did hear that Lululemon reports after the bell tonight. Maybe we could check what they're doing right now. Yeah, that stock unfortunately is down, so that might pressure some of those discretionary stocks tomorrow, because that had been kind of one of the hotter retail names out there in recent years. So it is definitely a momentum stock, and it's getting caught up to the downside with the momentum trade right now. So that has the possibility of breaking that XLY chart down below that moving average tomorrow. But as of right now, it's kind of interesting because it's sitting right there. Notice how the moving average is still green on discretionary, whereas it has changed to yellow on communications and on technology, a couple of the other once hot areas. So it would be really nice to see discretionary hold this level if it could, but it doesn't look like Lululemon at this point is going to help it out. Also, I wanted to point out before we get into our trade application, down below here, real estate, of course, is one of several bearish charts on the board here. I don't think it looks nearly as bad as the utilities chart, but nonetheless, just wanted to point out that real estate is considered bearish at this moment in time. And the reason I wanted to point that out is because that will have something to do with our trade application example. So let's get into that now. I'm going to come over here to, let's just do chart 3A here. And the stock in question, actually the REIT in question, Real Estate Investment Trust, is American Tower. And as I had hinted at earlier, this is a quote-unquote real estate, right? And I'm using air quotes because, you know, most of you are aware that American Tower is actually a cell phone tower company. They don't sell traditional real estate, they sell airwaves. But it has been a wildly successful business model in the last several years. You can see, if I were to pull up, let's say, a 10-year chart here, American Tower has been absolutely enormously successful. In fact, it became the biggest REIT for a while. It very well may still be at this point, and a lot of people still haven't kind of woken up to the fact that it is a REIT, let alone the biggest REIT. So it has been extremely, extremely successful as it is kind of gearing up for our 5G future, and has kind of participated along with a lot of technology stocks in recent years as a result of that connection to 5G. So it's kind of traded with the Apples and the Qualcomms of the world out there. Well, there's been a little separation here recently. And as you can see, this particular security has underperformed the S&P 500, which is this dotted kind of brown or gold line up on top here. And American Tower has largely just tracked sideways and then kind of taken a little bit of a turn lower here more recently. You can see that on this chart, we have a bearish near-term posture right now. That's what that pink background color signifies. Remember, this is the chart that I use in my factor-based swing trading class on Wednesday mornings, for those of you that attend that. You can also see that if we were to look at it from an intermediate posture perspective, that would also be considered bearish right now. You can see in the green label here, it says the intermediate line is at 28.49 and falling. So we have bearish postures from a near-term perspective. We have bearish postures from an intermediate-term perspective. We clearly have a relative underperformer versus the S&P 500. And you can see that after this quick little snap above the moving average last week, it didn't spend much time there. In fact, only one day until it reversed course once again and started falling below that falling moving average, which is why the moving average is red in this case as well. But the reason I selected this one as opposed to plenty of other REITs that look somewhat similar to this is this one also has what's known as a bearish divergence that's taking place on it right now. And what we're looking for there is a peak in the near-term line followed by a lower peak in the near-term line. So here you can see peak number 1, let's call it August 31st. And then peak number 2, let's call it September 3rd. Those two are, obviously, further away from one another in kind of height. This one is higher, this one is lower. Now, the candles that's associated with is this candle right here on the chart, and then also this candle right here on the chart. So in other words, price went up, making people that are just watching or reading the Wall Street Journal, just looking at prices, think, okay, everything's good during that time period. At the same time, indicator is down, telling us that, hey, there's something more negative brewing under the surface here that other people aren't picking up upon. And so now that we're bouncing down and away from that falling moving average, I thought this would be an opportunity to do a bearish trade. And I've already sent out these details. Remember, if you're a premium member and you have access to our Telegram service, we send out our trade alerts to you. And so I already sent this out earlier today. Some of you might have already got the trade filled as well. What I ended up doing was a bear call spread, and I sold the 260 call in October. So that would be this one right here. And I bought the 270 call in October, which would be this one right here. And so you can see that I got filled at a, if you calculate the trade prices here, the net effect of that trade was $2.50. So I got a credit of $2.50 on that $10 wide bear call spread. Now, for those of you that are newer to these spread trades, what I'm effectively saying here is that I want American Tower to stay bearish, and I want it to stay below $260. In fact, because I got a credit of $2.50, really I need it to stay below $262.50 in order to expect to make some profits off of this trade. So that opens me up to the possibility of having this stock go sideways, go lower, or even go higher. We just don't want it to go up too much. So this is a $246 stock right now. As long as it doesn't go up by, let's say, $15 or more, then we should have a decent chance of making some money on this trade. Now, if you want to look at where our break-evens would be on the chart, remember 262.50, if you include the credit I received on the trade, would take us to about right here where I'm circling on the chart. So in other words, the last time it traded at that level would have been on this candle back here on in July 31st there. So if you think that this downtrending 30-day moving average will continue to act as resistance the way that it did back here, then that should be a reasonably safe place to be. Then again, it was the month of October, so we'll have to be in these for another month. But if you expect turbulence in the market and this stock to continue to kind of meander or trend a little bit lower, then this is a bearish trade idea that you could potentially benefit from. Okay, so that's our trade idea. I appreciate those of you checking out this video. Once again, another big day here today, another big sell-off day. So we'll see where this takes us. Remember that a lot of the companies that have been struggling the most are the ones that were up the most previous to this past week or so. So the rest of the market isn't doing nearly as badly, but without a doubt, we're starting to hit a little bit of turbulence as we head into the month of September here. So keep your head on a swivel, stay buckled in tight. There's plenty of opportunities out there if you're keeping your eyes open for them as well. And we hope that you'll continue to watch these videos for those opportunities. David should be back with you tomorrow. I'll be back with you on Thursday. If you got value out of this video and you want me to do a full-length version again, hit like for me there on Twitter, and I'll see you all on Thursday. Take care, everybody. Bye-bye.